Welcome to lecture 21 of International Finance. In this video lecture, we are going to start a new topic, and this topic is related to exchange rate systems. So basically what we are going to explore is that when we talk about exchange rate, then what are different systems that are there in place? By system, we mean that how do we convert or what is according to which system do we convert one currency into another currency, how these currencies fluctuate or remain fixed, what are the reasons, not in terms of determinants, but in terms of which system a country is following. So we are going to discuss fixed and floating exchange rate system, and then we would see what are the advantages and disadvantages of these two systems. Then we would have a packed currency system, but before that we would consider a managed floating, which is somewhat between fixed and floating exchange rate system. It is neither fully fixed, strictly speaking, and neither fully floating. It is somewhere in between these two types of systems. So we would then explore packed currency, and within that we would have currency board and dollarization. Okay, so starting with the exchange rate systems, we have four main types of exchange rate systems. We have fixed exchange rate, we have floating exchange rate, or what we call free floating. Then we have managed float, and then we have a packed currency, right? So starting with the fixed exchange rate system. So when we say that $1 is equal to 160 rupees, then is this exchange rate, the value of one currency in terms of another currency, is this fixed by government, or does this change with respect to certain forces, right? So this is what we are going to discuss, and this is what we mean by system. So once you have an understanding of fixed exchange rate system, you would get an idea what do we mean actually by systems. So in fixed exchange rate system, the rate are held constant, right, or allowed to fluctuate within a narrow range. What this means is that, for example, Pakistan is following, this is just an example, hypothetical example, Pakistan is following a fixed exchange rate system, then this $1 is equal to 160 rupees would always remain this way. It would not change, right? Or the government can allow it to change within a narrow range, say within 155 to 165. So in fixed exchange rate system, the exchange rate, the rate at which a currency can be converted, a home currency can be converted into foreign currency, is held fixed. So another definition of fixed exchange rate system is that a currency can always be exchanged for same amount of the other currency or gold. So this term, the gold, is new as compared to the previous definition. What this means is that when we talk about fixed exchange rate system, it doesn't necessarily means that we are talking one currency in terms of another currency. It can be that say for example, Pakistani government have fixed rupees, say for example, in terms of gold, right? So say they have fixed that 100 rupees would be equal to 1 ounce of gold, right? So it is not necessary that this currency being fixed in terms of another currency, but it can be fixed in terms of another asset. So in both those cases, it would be called a fixed exchange rate system. An interesting example is Hong Kong dollar, right? So it is fixed between 7.75 and 7.85. It do vary, right? But within this range. So the exchange rate of $1 is equal to 7.75 Hong Kong dollar, right? So, so this is also an example of fixed exchange rate system, but in this case, you would get an idea that it is fixed, but it is allowed to vary within certain range, right? Okay, so although these terminologies would be new for you, but just we would explore these terminologies later on in lectures. There was an agreement which is called Bretton Woods Agreement, and this agreement fixed each currency's rate in terms of dollar. So this Bretton Woods Agreement is also a fixed exchange rate system. We would explore this Bretton Woods Agreement in detail in later videos, but for now just keep in mind that this Bretton Woods system is a fixed exchange rate system. Similarly, this agreement, Smithsonian Agreement, then there is a standard which is called gold standard, which we are going to explore in our next video. And these packed currency, these essentially are fixed exchange rate systems, right? So currently, Oman, Qatar, Saudi Arabia, Turkmenistan, UAE, Venezuela, they follow a fixed exchange rate system, but they fix their currency in terms of dollars. So, for example, one dirham is $1 is equal to 3.2 dirhams, right? And it had been this way for quite long. So the reason is that the government of UAE had fixed the exchange rate system in terms of dollars. Okay, so what are the advantages of fixed exchange rate system? First is so one of the advantage of fixed exchange rate system is that it contains less exchange rate risk. If you remember from our previous lectures, you know that when there is higher fluctuations or higher volatility in the exchange rate, then MNCs are exposed to exchange rate risk, right? And we have clearly discussed this idea. But when the exchange rate remains fixed, then that risk for the MNCs is eliminated. Now exporter would not have to worry about the currency, foreign currency depreciation, or the importer would not have to worry about the foreign currency appreciations, or vice versa. So the exchange rate risk is eliminated due to the fixed exchange rate system. The second is that it is easy in FDI, as future earning can be converted without risk. This is also similar to the first point in terms that this advantage is particularly related to balance of trade or export and import. But this advantage is specifically related to foreign companies opening their subsidiary in your home country. In that way, when they bring the FDI, they know that their future earnings value would not be lesser than what they would expect. And similarly, it's easy for international portfolio investment. So anyone buying the shares, they know that the future dividend would not be worth less, or the future interest rate amount being converted back into home country would not be worth less. And again, it limits the currency speculation, right? And this currency speculation, because investors know that there is no fluctuations, then they do not expect to buy it at lower price and sell it at higher price, and this eliminates the currency speculation. The disadvantage is that still, although the exchange rate is fixed, but the government still have the power to revalue or devalue their currency. When they increase the value of their currency, then that is called revaluation, and when they decrease the value of their currency, then that's called devaluation. As opposed to appreciation and depreciation. When we would discuss free float or floating exchange rate system, and in all previous lectures we have always assumed that there is free float exchange rate system. In balance of payment, in determinants of exchange rate, we have always assumed that there is a floating exchange rate system, and that's why we have used the term appreciation and depreciation. In free float or floating exchange rate system, the currency would either appreciate or depreciate, and this would happen not because of government intervention, but because of the market forces. But when we use term revaluation or devaluation, then we specifically mean that the change in currency value due to government intervention. So, although the exchange rate risk due to the day-to-day volatility is eliminated for the importer exporter, but the risk that government can devalue or revalue the currency is still there. Okay, this is more kind of a macroeconomic disadvantage, is that each country is also vulnerable to the economic condition of another country, and to understand this we would have to consider an example. Say for example, assume that there are just two countries in the world. One is Pakistan and the second is US. Now assume that although the US inflation remains same, Pakistan's inflation increases, right? And we have a fixed exchange rate system. So in previous examples, we always assume that when inflation would increase in one country, its currency would depreciate, right? And that shock of inflation would be absorbed by currency. But in fixed exchange rate system, this shock absorber is not there. So what would happen is that if inflation would increase, then Pakistani goods would get more expensive. So the Pakistani nationals would want to buy a US product because they have now become cheaper for Pakistani nationals. So what would Pakistani nationals start doing is they would start importing US goods, and in this process what would happen is that in US the demand of product or the demand of US product has increased, and hence their prices would increase. The demand is increased because of imports. So that means the inflation in Pakistan is exported to US. So in that way, the economic condition of one country do also affect the economic condition of another country, and also because Pakistan's imports, Pakistan's local consumption of local products have decreased, so the unemployment would also increase, right? So the situation for Pakistan would worsen if there was a fixed exchange rate system, right? Okay. Then the issue that central bank would have to maintain a large currency reserve, and the reason is that the exchange rate would remain fixed in a way that central bank would continuously have to intervene to keep them fixed. When they would see that the supply of rupees has increased, what they would do is they would start buying those rupees from the market in terms of foreign currency, right? Or they would increase the supply of foreign currency in the market. So to increase the supply of foreign currency in the market, they would have to maintain a high reserve, So that's one more disadvantage of fixed exchange rate system. Okay, so this brings us to free floating exchange rate system, and from our previous discussion it would be clear that in this system the rates are determined by market forces rather than the government, and government do not intervene. This is a strict free float system. When we move forward and study the managed floating, then you would see that the rates are not strictly determined by the market forces, but government do play their role. So some of the examples that follow free floating exchange rate are the most developed countries, say for example United States, United Kingdom, Australia, Canada, and these are also some other countries that do follow floating exchange rate system. The advantages is that each country is more insulated from economic problem of another country. Now in previous example you saw that inflation of Pakistan was exported to US. If there is free float exchange rate, then what would happen is that when the inflation in Pakistan would increase, its exchange rate would decrease. By so in that way, still the US products for Pakistani national would not become less expensive. So they would still remain expensive, because although the inflation have increased, but the exchange rate have decreased. So when they would buy from US, they would get still an expensive product. So rather they would keep buying from the local manufacturers. The central bank intervention just to control the exchange rate and are not needed. So this is one of the advantage, that the central bank's intervention is not needed, and they would not have to maintain high reserves. The disadvantage is obviously the disadvantage of free float is the advantage of fixed exchange rate, and in fixed exchange rate MNCs had an exchange rate risk, right? In fixed they didn't had exchange rate risk, but in free float they would have an exchange rate risk, and they would have to devote substantial resources to manage that risk, right? They would have to hire risk managers. They would have to maintain certain capital to absorb that risk, right? And then the country that initially experienced economic problems such as high inflation, increased unemployment, may have its problem compounded. And what this means is that, continuing our previous example, if inflation in Pakistan increases, then if there is free float, then its currency would depreciate, and when that would happen, the imports of raw material that they are going to make from US would also become expensive. Hence there would be a spiral effect of inflation, right? So their economic problem would be compounded. So they importing from US would their imports from US would also get expensive because of devaluation, or rather depreciation, of the rupees. Okay, here we come to managed float exchange rate. In this exchange rate system, the exchange rate are allowed to move freely on daily basis, and no official boundaries exist. So on daily basis they would move freely, but occasionally if the government or central bank wants, they can manipulate the exchange rate. So in Pakistan we have managed float system, and there are example of some other countries that do have managed float exchange rate. So government may intervene, that's what we have discussed. And one of the criticism on managed float system is that In managed flow system, the system allows the government to manipulate exchange rate in a manner that can benefit its own country at the expense of other countries. So, for example, a government may attempt to weaken its currency to stimulate a halted economy, stagnant economy, to increase the demand of its product in foreign countries, right? So this is one of the criticism on managed float exchange rate. Then we have packed exchange rate system. In this system, the currency's value is packed to a foreign currency and thus moves in line with that currency. So remember in our first slide, when we were discussing fixed exchange rate system, we said packed exchange rate system is also a kind of fixed exchange rate system. So essentially what we have is we have two types of systems. One is fixed and the other is floating, right? And so this packed is also a type of fixed exchange rate system. And then managed floating is a type of floating exchange rate system. So in this packed exchange rate system, the currency value is packed, it's linked to a foreign currency. So if that foreign currency moves, then the home country currency would also move. So for example, if dirhams are fixed in terms of dollars, so if the UAE government decides that $1 should be equal to 3.2 dirhams, then we also discussed this example in fixed exchange rate system, but essentially it is a packed exchange rate system. Why is that so? Because the UAE government have linked the exchange rate to another currency, right? So some government peg their currency value to that of a stable currency such as dollar. This is what we have discussed. So when they link their currency, they peg their currency to a stable currency. In that way, their own currency becomes also stable. And this is only advantageous when peg is not broken, because if there is political or economic instability in a country, then what would happen is that now before that you need to understand that how this exchange rate is kept fixed is in terms of the government intervention, right? So what central bank do is that if the supply of dollar becomes scarce in an economy, let's say the UAE economy, then what the central bank would do is that it would supply it increase the supply of dollars in UAE from its reserves. So, but if there is political or economic instability, then the demand of foreign currency would increase quite a lot, and the central bank might not be able to continue the peg. They might not have enough reserves to continue the peg, and that way the peg might be broken. This currency board is a further subtype of pegged currency system, and a currency board is a system for pegging the value of local currency to some other specified currencies. So in this case, for example, we discussed the Hong Kong dollar 7.8 being pegged to US dollar, right? Similarly, El Salvador's currency being pegged to a US dollar. So this currency board is an extreme type of pegged exchange rate system, and in this system, the monetary authorities or the central bank have the instructions to back all unit of domestic currency in circulation with the foreign currency. So currency boards offer stable exchange rate system, right, which promotes the trade and investment. So the advantage of this currency board is that it would stabilize the currency value. So when we link an exchange rate, our home country's exchange rate, to a foreign country or multiple currencies, then what would happen is that our home currency would have more stability, right? So small changes in the political events or economic events or economic indicator would not affect our home currency by much. It is effective only if investors believe that it will last. Now, if you remember in pact exchange rate, we discussed that this pact is only beneficial if the central bank or the monetary authority can continue the pact. If they cannot continue the pact, then it's not effective. So if investors believe that this pact would not or this currency board would not be sustained, then what would they do is they would keep their demand of foreign currency high. And again, as we discussed in previous slide, this higher demand, if this cannot be sustained by the monetary authority, then this currency board or this pact would be broken. So if the investor do not have confidence in this currency board, then it would not be advantageous. This is one of the example is that the Brunei Darussalam's currency is fixed to the Singapore dollar, right? And lastly, we have dollarization. In dollarization, what happens is that the home currency is replaced with a foreign currency, right? And in this case, say for example, with the US dollar. So this process is a step beyond a currency board because it forces the local currency to be replaced by US dollar. In currency board, we do not replace the local currency with foreign currency, but in currency, what we do in currency board is that we just link our home currency with other currencies. But in dollarization, what we do is we eliminate the local currency and we simply replace that currency with a foreign currency. So it is a one step beyond currency board, as the country's own currency would not exist. But essentially, dollarization and currency board are both a pegged exchange rate system. So they are pegging the local currency's value. The currency board do not replace the local currency, but in dollarization, we do replace the local currency. Okay, so for example, Ecuador implemented dollarization in 2000. So they eliminated their own currency, and what they did is that they adopted US dollar. Some other currencies that do have dollarization is El Salvador, Marshall Islands, then we have Panama and Zimbabwe. So these countries follow dollarization. They do not have their own currency, rather they use US dollar. So that brings us to the end of this lecture, and in next lecture what we are going to do is that although we have discussed multiple exchange rate systems, different exchange rate systems, but throughout the history, how these exchange rate systems evolved, right? This is what we are going to discuss in next lecture, the evolution or the history of exchange rate systems.